Welcome to Accounting Actuals. We simplify accounting and bring practical insights on the financial tools that every business needs. Today, we're diving into a mistake that even smart entrepreneurs make: mixing personal and business finances. Sounds small, right? But it can quietly sabotage your tax strategy, your financial clarity, and your credibility. Let's break it down. What does mixing even mean? Mixing means using business funds for personal expenses, like groceries, Netflix, or gas for your family car, or vice versa. It also includes having one shared bank account for everything, even if you plan to pay it back. The IRS, your CPA, and your future investors won't see it that way. Why it's a big problem. Reason 1: tax time turns into a nightmare. You'll spend hours digging through receipts and trying to explain to your CPA why a Louis Vuitton bag was for the business. Here's the truth: your CPA is not your bookkeeper. They're an IRS certified tax preparer, legally responsible for reporting your company's income to the IRS. If they see personal charges on your books, especially repeated or questionable ones, they will frown upon it. And in some cases, they may even refuse to file your tax return until this is fixed. That's a professional boundary you don't want to cross. Reason 2: you pierce the corporate veil. If you operate as an LLC or Corp, mixing finances can destroy your legal protections. That means if you're sued, your personal assets could be on the line. Courts call this piercing the corporate veil. And once that veil is pierced, your LLC or Corp status won't shield you anymore. Even if you have articles of incorporation, bylaws, or an operating agreement in place, if the court sees you treating your business like a personal piggy bank, that paperwork won't protect you. Reason 3: your numbers lie to you. Your P&L report becomes unreliable. When personal expenses are mixed in and labeled as business, the numbers stop reflecting the truth. You can't improve what you don't understand. If your margins look good on paper but are built on false data, you're flying blind, and sooner or later, that catches up with you. How to fix it fast. So how do you avoid the mess? Step 1: open a separate business bank account. Step 2: use accounting software like QuickBooks, Xero, or Wave. Step 3: if you do need to pay yourself, use payroll or distributions, not your business card. Step 4: work with a professional, like a fractional controller or CFO, to clean it up and stay compliant. What if you made a mistake? All right, let's say you accidentally swiped the business card at the grocery store. It happens. You're human. Make it a one-time mistake. If it becomes a habit, you're risking your business credibility. Here's what to do. Immediately: reimburse the business. Transfer the exact amount back into your business account, and document the transaction clearly. Label it properly in your books. Use a journal entry or owner's draw adjustment, depending on your entity type. But don't just ignore it or mislabel it as a business expense. If you've already mixed things up, don't panic, but don't ignore it either. Clean up now. Create an audit trail. Get your books GAAP ready. Thank you so much for watching. For more information on how we can support your financial goals, be sure to check the details in the description below or visit our page.